Recession concerns, we've got them everywhere. They're weighing on the minds of investors as market volatility is persisting. And you see there Jay Powell testifying before the Senate right now, giving his opening remarks. And that's after some fiery opening remarks from Senator Sherrod Brown, who helms the committee there. So let's talk more about the outlook for the economy. Lauren Goodwin is joining us now, New York Life Investments economist and portfolio strategist. Lauren, thanks for being here. Among other things, in those prepared remarks, the Fed chair said the U.S. economy is strong enough to withstand tightening of rates. Do you agree?
I do agree. For all the talk of recession, it's not in our base case for the next 12 months. And that's because consumer and corporate balance sheets coming off of this pandemic crisis are incredibly strong. But I have to tell you, whether the real economic data suggests that we're in recession or not here in the next couple of quarters, it might not matter much for the decisions that people are making today for two main reasons. The first is that we know wages are not keeping up with inflation. Real incomes are falling, and that feels like recession for many households, even again, if the official data doesn't say so. And the second reason that it might not matter very much for decisions today is that the sort of recession resilient asset allocation policy that worked in the previous cycle isn't likely to work in this cycle when inflation is so high. Inflation can create a significant drag on wealth.
And so it seems like it's got all the makings of kind of a quasi-recession right now, if you're saying it feels like, or it seemingly is so, without necessarily, by the technical definition, being it right now. 12 months is what you said. You don't see a recession within. Further along, though, depending upon the Fed's route, is there anything that you would look for in their policy to suggest that maybe we could see one?
Yeah, well, first of all, I'll say that historically, there's about a 20% risk of recession in any given year ahead anyway. And so there's always a risk of recession. And the longer out we go, that risk increases. And I do see that risk of recession increasing over the 24-month term. Our models suggest a risk of about 70%, which is substantial. Now, when we're looking at Fed policy today to determine whether the risk of, even in the next 12 months, recession risk increasing, the main thing that we're looking for is for economic growth to stabilize or slow. That's what it's going to take to move inflation lower and to take the Fed's foot off the brake. And the reason I say that is because the Fed chair himself has said that they're extremely committed to bringing inflation lower, and because it takes a slowing economic growth to do that. And so we've seen many of the indicators of a peak hawkishness environment already. It's the slowing economic growth that we need to see ahead.
Lauren, everybody's dusting off their playbooks for, if not recession, at least sharply slowing growth, right? And you guys are looking at value stocks in particular as one way to get into that playbook, right? So how have they behaved in the past in these types of periods?
Well, I'll first say that one of the reasons why we're looking at value equity as a high conviction bet in our portfolios is that when inflation is this high, it's really challenging to rely on previous recession resilient strategies, things like cash, core bonds, and treasuries, because inflation takes a bite at those returns. And so staying fully invested, including in equities, we believe is important to help build resilience against inflation. Now, why value equities? Well, even though growth equities have taken a major hit as interest rates have risen, they're still relatively expensive compared to value equities. We also see major risks ahead for growth equities as interest rates, we believe, have not yet peaked. And because so much of the earnings potential of these companies has been pulled forward because of the purchasing patterns during the pandemic that you were describing earlier. And so we see value equity as, again, a way to stay invested and to build some resilience both against inflation and against volatility, which we expect in broader equity markets.
Lauren Goodwin, who is the New York Life Investments economist and portfolio strategist. Thanks so much for the time this morning. Appreciate it.